Hey everyone, and welcome back to Everyday Finance, where we break down money tips into simple, everyday steps you can actually use. Loans are everywhere, for school, cars, homes, and sometimes just to get by. They can be powerful tools, helping you achieve major milestones, but they can also turn into a huge burden if you don't understand how they work. Today, we're going to break down everything you need to know about loans and interest rates so you can borrow responsibly and avoid common financial pitfalls. So, let's start with personal loans. These are the versatile workhorses of the lending world. They're typically unsecured, meaning you don't need to put up any collateral like your car or house to secure the loan. This makes them a bit riskier for lenders, and that usually translates to slightly higher interest rates compared to some other loan types. But the real beauty of personal loans is their flexibility. You can use them for just about anything, consolidating high-interest debt, covering unexpected expenses, or even funding a dream wedding. A personal loan can help you consolidate that debt into a single monthly payment with a lower interest rate. Now, the interest rates on personal loans can vary widely, and your credit score plays a huge role here. A higher credit score tells lenders you're a less risky borrower, which often qualifies you for those lower interest rates. It's always a good idea to shop around and compare rates from different lenders before you commit to a personal loan. Only borrow what you need and can realistically afford to pay back. Next up, we've got student loans. Those trusty companions for anyone pursuing higher education. These loans are specifically designed to help you cover the cost of tuition, books, living expenses, and everything else that comes with going to college or trade school. There are two main types: federal student loans and private student loans. Federal student loans are funded by the government and typically come with lower, fixed interest rates and more flexible repayment options. Private student loans, on the other hand, are offered by banks and other private lenders. It's super important to exhaust your federal student loan options first, before considering private loans. Start by estimating your total loan debt and understanding the terms of your loans, including interest rates, repayment periods, and any grace periods. Even paying $50 a month towards your loans while you're still in school can save you thousands of dollars in interest over the life of your loans. Let's talk about auto loans, because who doesn't love the feeling of driving off in a shiny new car? But before you get behind the wheel, let's talk about how these loans work. Auto loans are designed specifically for buying a vehicle, and they're usually secured loans. This means the car itself acts as collateral for the loan. Just like with personal loans, your credit score plays a big role in the interest rate you'll get on an auto loan. A higher credit score means you're more likely to snag a lower interest rate, which translates to lower monthly payments. When you're shopping for an auto loan, you'll come across two main types: direct loans and dealership financing. Direct loans are offered by banks, credit unions, and online lenders, and they typically give you the chance to pre-qualify for financing before you even visit the dealership. Dealership financing, on the other hand, is arranged through the dealership itself. Here's a pro tip: don't be afraid to negotiate. Negotiate the price of the car, the interest rate on your loan, and any add-ons the dealership tries to throw in. The key is to be prepared to walk away if you're not comfortable with the terms. Okay, now let's talk about mortgages. Those big, sometimes intimidating loans that help you buy a home. It's probably going to be the largest loan you'll ever take out, so understanding how they work is crucial. Mortgages typically come with repayment periods of 15 to 30 years, and during that time, you'll be paying back both the principal and interest. The interest rate on your mortgage can have a huge impact on the overall cost of your loan. Just like with other loans, your credit score plays a big role in the interest rate you qualify for. Before you even start house hunting, get your finances in order, check your credit score, and work on improving it if needed. There are tons of different types of mortgages out there, each with its own set of terms and conditions. Fixed-rate mortgages lock in your interest rate for the entire life of the loan, providing predictability. Adjustable-rate mortgages, or ARMs, have interest rates that can fluctuate over time. Make sure your mortgage payments fit comfortably within your budget, leaving room for other expenses and savings goals. Finally, let's talk about credit cards. Now, technically, credit cards are revolving loans, meaning you have a revolving line of credit that you can borrow from up to a certain limit. Credit cards can be incredibly convenient for everyday purchases and emergencies, and they can help you build credit if used responsibly. But credit cards often come with much higher interest rates compared to other types of loans. The key to using credit cards effectively is to avoid carrying a balance whenever possible. Aim to pay off your credit card balance in full each month to avoid those high interest charges. Managing your credit card responsibly is crucial for building a solid credit history, which can open doors to better loan terms and financial opportunities in the future. So use your credit card wisely, pay your bills on time, and keep your credit utilization low to build a strong credit profile. And there you have it, everything you need to know about loans and interest rates. I hope this video empowered you to navigate the world of borrowing with confidence. If you found this video helpful, give it a thumbs up, and don't forget to hit that subscribe button and turn on notifications so you never miss a new video. Got a question about loans or interest rates? Drop it in the comments below. I read every single one. Until next time, take care of your finances, and I'll catch you in the next one.